markets in chaos, trade wars escalating, debt spiraling. If you're still relying on old investment playbooks, you're setting yourself up to lose. It's time to rethink everything you know about wealth building in this new world order. Stop. You need to stop following conventional wisdom if you want to succeed in your investment and make generational wealth. This video will enlighten you on the undercurrent sweeping the investment landscape and propel your investment returns to new height. Investment strategies that had performed brilliantly in the past decade would struggle to perform in the next decade. We are now at the cusp of a major paradigm shift in global trade relations, and the investing climate will be vastly different from here on. Following conventional wisdom, blindly buying the dip or taking risk off could cost you dearly. Watch this video till the end to demystify the paradigm shift in global trade policies, the US federal debts, and the AI revolution. At the end of it, you would be able to make informed decisions to future-proof your investments. Welcome to The Money Dove, a channel all about stocks, options, investing, and financial decisions, to embark on a journey towards financial freedom. Be sure to like and subscribe. What has really changed in the investment climate? The euphoria behind artificial intelligence and automation had brought the market to an all-time high and incredible valuation. However, this momentum and sentiment had been completely usurped and taken over by the encroaching trade war and was quickly popped on that fateful Liberation Day. The scale of the tariffs introduced by the United States was beyond the wildest imagination of most analysts. Needless to say, the reaction of the market was also extravagant. Believe we need not dive into details on the panic that seized the market in the days and weeks following the announcement. Beyond the trade war, the massive federal debt on the U.S. government balance sheet is a big-time bomb and risk to investment portfolio worldwide. The only saving grace for investors is the quick advancement of artificial intelligence and productivity growth from it. Was it really the United States that fired off the first salvo this time round, or was something else already brewing before that? Even before the massive wave of tariffs that was rolled out on Liberation Day, developed countries had already begun to impose tariffs on different Chinese goods. For years, various tariffs or non-tariff barriers had been put in place against China, often in a more elegant phrase called anti-dumping duties. It's not just the developed countries imposing these barriers. Even developing countries like Mexico and Indonesia had or were planning to put up these barriers against Chinese goods. The more common products involved are usually the like of steel or solar panels. However, in recent years, this had expanded to higher tech products, especially electric vehicles. In fact, the European Union, Canada, and the United States had all imposed hefty tariffs on Chinese electric vehicles in 2024. Yes, it was the United States that fired the first salvo again, but it was the Biden administration that did so, not tariff man Donald Trump. Globalization is truly wonderful. It had been an incredibly powerful engine powering the global economy in the past decades. It's a system where people do what they are best in. The shoes are made by the best shoemakers. The grains and vegetables are planted on the most fertile lands. And the computers are made by the best manufacturers. In such a system, the world output massively increased by putting scarce resources to the best use. Now, the developed countries are attempting to reverse the wheel of globalization and stop this powerful engine. Or is that really the case? Is the United States really trying to bring all type of manufacturing back to their own shores? Or are they only interested in certain high-value industries? There are a few main factors that would determine the trajectory of global investments for the coming years. Global trade policies, the United States federal deficit, and the development of artificial intelligence. Anyone that could tell you with certainty how these events would turn out are kidding themselves. As the famous hedge fund manager Ray Dalio had once said, "He who lives by the crystal ball will eat shattered glass." However, that don't stop us from analyzing the potential outcomes and adjusting our risk accordingly. Now focusing on global trade policies. The United States is now negotiating with their global trading partners on the reciprocal tariffs. With a deadline of 90 days before the extension of the reciprocal tariffs is over, the United States is running on a tight deadline to extract as much value as possible from the trading partners. Many countries like Vietnam, Indonesia, Taiwan, Japan, India, and even Italy had started negotiation with the United States. The United States will likely try to make their trading partners absorb a good portion of the base tariff of 10%. indirectly asking for a transfer of wealth from their trading partners to the United States Treasury. On top of that, they are also likely to make their trading partners finance their debts by buying Treasury bonds. Last but not least, the United States would also try to close the trade deficit by making their trading partners buy their imports. How much value the United States managed to obtain from their trading partners would indirectly result in a transfer of wealth between them. It is likely to affect the relative performance of the respective stock exchanges. While China is a big factor affecting the outcome of the trade war, it would require a much deeper analysis. Without deep diving into China, we could simplify the outcome into two binary results. The first outcome, where negotiation broke down, the United States and China formed two factions in global trades. The second outcome is much rosier, where the United States and China strike some kind of deal and cooperation on trades continue. As for the rest of their trading partners, it is likely that the United States could extract a good amount of values, especially from trading partners that are very export-dependent. However, with the tight deadline and China competing for global influence, it is unlikely that the United States get everything they want. Nevertheless, this outcome would be favorable to the United States and its economy. Such outcome does create further friction in global trades and is likely to provide further headwind to global growth, especially in the developing world. The friction could be a hurdle for U.S. stocks more dependent on the global market and non-U.S. stocks, something we have to keep in mind. Moving on to federal debt, no doubt a big reason for the accelerated growth of the U.S. economy and its stocks market over the past years can be attributed to federal debt. This chart shows the U.S. government debt as a percentage of the U.S. GDP. While it seems as if the debt had been kept in control after the huge jump during COVID, most of it could be attributed to the runaway inflation and its impact on nominal GDP. If we look at the absolute number, the situation is less optimistic. The U.S. government continues to incur deficit year over year, resulting in an ever-climbing federal debt. Such runaway debt problem is a ticking time bomb that needs to be addressed as early as possible. The interest payment on U.S. federal debt could reach a staggering $1 trillion per year and would be one of the biggest expenditure of the government. To keep the debt in check, the U.S. government has to either let high inflation reduce the real value of the outstanding debt or rein in spending. Unfortunately, letting inflation eat into the value of the debt would backfire splendidly. Not only does it destabilize the economy, but it would also force the Federal Reserve to increase interest rate, further increasing the interest payment on the debt. On another hand, reining in government expenditure would clearly slow down the economy, as the U.S. federal deficit in 2024 was $1.8 trillion, or 6.4% of its GDP. Can you imagine the U.S. economy slowing down by 6.4% in a single year? That would be catastrophic, not just for the United States, but for the entire world as well. Could the use of tariff and extraction of values from their trading partners help the United States to completely close its annual deficit then? The answer is a clear no. The United States annual import is valued at $3.3 trillion in 2024. Even if they do manage to make all their trading partners absorb 10% of the tariffs and on all the imports, it is only a little over $300 billion, or less than 20% of its annual deficit. To be clear, it does help, but by itself, it is insufficient. However, there is another way. Many audiences would have caught on at this point. The fact that the interest payment on federal debt is more than half of the annual deficit. This means that as long as the United States could get the Federal Reserve to cut interest rates back to near zero levels again, they could effectively reduce their annual deficit by more than half. That, or making their trading partners finance their debt at close to zero interest. Now we see where this recent drama on trade war and tariffs is leading to, isn't it? With all that said, we do believe that the outcome of the tariffs negotiation is likely to be tilted in the United States' favor. It is likely that they could get the trading partners to absorb a good portion of the remaining 10% tariff and for their trading partners to provide cheap financing. Yet, it is of low probability that those could completely solve the federal debt issue, which would continue to generate headwind for the economy. Finally, moving on to something of a positive note, artificial intelligence. The recent tariff development had seemingly overshadowed the breathtaking advancements in artificial intelligence. The development of generative AI in both image generation and video generation had taken a huge leap forward, blurring the line between reality and digital. The barrier of entry and cost of advertisement and video creation will be drastically lowered, and we would see huge opportunities and proliferation of advertisement and content creation. On top of that, agentic AI would be able to replace most administrative works. With the AI technology rapidly advancing every single day, it is definitely going to create a lot of productivity gain, which impact will not be any less than the Industrial Revolution. Unfortunately, many jobs and industries will be phased out, but many will be created as well. It is of utmost importance for investors to recognize and identify the trend of industry disruptions, positioning themselves to capture the tailwind of the AI revolution. Having covered 3 major paradigm shifts which would determine the investment landscape in the near future, how do we intend to position our investment portfolio then? The tariffs negotiation is likely to produce some positive result, providing some short-term tailwind for the stocks market. This would require us to continue to be invested in the U.S. stocks market. Next, the stocks market remained relatively expensive in valuation term, even after retreating a lot from the all-time high. The overall valuation is also propped up by big names, some of which has rather inflated valuation or PE ratio. We would reduce our exposure on index ETF, focusing on stocks with reasonable valuation instead. We would also focus on stocks that are able to capture the tailwind provided by AI. Such stocks could include companies involved in energy infrastructures, semiconductors, and internet content intermediaries. With continued headwind due to the federal deficit in the midterm, we would take profit appropriately through the use of selling options. Heightened volatility in the market would provide incredible income for selling options. Covered calls or wheel strategy would produce amazing result, generating strong and steady income flow. And that's all for this video. Thank you for your support, and we hope this video could help you, our audiences, better understand the paradigm shift in the investment landscape. Let us know in the comments section below what you think of the investment landscape and what you would like us to discuss next. Don't forget to hit that like and subscribe, and see you again.